On Wednesday, the 3rd of March, the Chancellor delivered his three-part spring budget. We caught up with our tax team for their thoughts on the measures announced.
Yeah, I think the main point from my perspective is the whole issue around R&D and the consultation that's going ahead at the moment. So obviously we've seen a big commitment from the government in the last few years regarding R&D to sort of capitalise on our international standing for science and innovation. So R&D tax credits have been a huge factor in sort of supporting that technological ecosystem. So the consultation was committed to spending 2.4% of GDP in this area by 2027. So that's going to encourage further innovation and minimise the sort of cost for the claimants in terms of undertaking their qualifying activities. So that's going to enable them to get products to market quicker than they would do ordinarily in theory. That consultation ends 2nd of June and basically will establish if the current system is fit, how it's targeted, does it make us internationally competitive, etc. So there'll be big movements in terms of R&D in the future years in terms of looking at all of that.
I think for me it was more about what wasn't included within the budget. I think everyone's been expecting the last 6 months that we're going to get an increase in capital gains tax rates. And clearly that wasn't included. There have been mutterings, I think, the last few months that because where we are with the pandemic, perhaps it probably wasn't the right time to address that. And I think the Chancellor sort of alluded to that yesterday. I do, however, think that it is something that's on the agenda. And if we get an autumn statement, or perhaps even have to wait till next April or next March, I think it's something that definitely will be re-looked at, I think.
Most of the biggest shake-ups from the budget were in respect to corporation tax. Increasing the main rate to 25% is anticipated to affect in full about 10% of companies. The change looks beyond the pandemic and won't take effect until April 2023. I think the introduction of the small profits rate is interesting. This rate's remaining at the existing 19% for businesses with profits of 50k or less, and I do suspect that the 50k limit has been set to align with the higher rate thresholds for income tax. It could be that we see a change in remuneration planning in the future. I think the two rates of tax will see the return of marginal relief calculations and associated company rules, something which most tax advisors were glad to see goodbye to a few years ago. But in summary, whilst it's not going to be a popular change, it does place the burden on the successful businesses, and it counters the new loss relief opportunities for those that are still struggling.
So as head of employment tax, I was really listening for announcements that were going to affect employers. Obviously, we had the extension of the furlough scheme, which was good news. But the other thing that really caught my eye was the setting up of the Taxpayer Protection Task Force. So the government has announced that they're going to spend £100 million setting up a team of 1,250 investigators, and this team is going to tackle the fraud in the COVID schemes. Furlough is likely to be a focus of this. HMRC have already set up a number of investigation teams just looking at furlough fraud, because they estimate that £3.5 billion of fraud has already gone through the furlough scheme. So these investigations have already started, and they're looking at them from the whistleblowing reports and data analysis. And what this announcement has told me is that this is clearly going to gather momentum over the coming months and years. So employers need to make sure that they are claiming correctly.
Yeah, so we welcome the government's decision to extend the coronavirus job retention scheme for a further 5 months. The extension to the scheme is going to see employees continue to receive at least 80% of their normal pay, up to the cap of £2,500 per month for any unworked hours. So there's no changes from that side. Businesses will be required, though, to start contributing to wages, and July is the first point in which they will be asked to do that. So we're going to see the scheme start to taper, so similar to how it did last year, in that whilst employees continue to receive that 80% of normal pay all the way through up until the end of September, employers will then, at that stage in July, be expected to contribute 10%, so they'll be claiming back 70%. And then in August and September, that will fall to 60% to be able to claim back, so a contribution of 20%. There's no change to the fact that the employer still covers the cost for employers' national insurance and pension. However, it's good to see that the scheme is being extended.
I think from a capital taxes perspective, it was good to see that there were no major structural changes to the tax system this time round, and in particular no changes to capital taxes, which is a relief for a lot of people. We are, however, expecting a number of consultations to come on tax day on the 23rd of March, which might include a look at capital gains tax and inheritance tax. So I think the message is watch this space when it comes to that.
There wasn't much mentioned about capital taxes that would be pertinent to private client tax, such as capital gains tax and inheritance tax. The bans and thresholds were frozen until 2026, but other than that, not much was mentioned. So for me, it piqued my interest more for the autumn statements. The Chancellor mentioned a huge deficit that will need to be closed. And I wonder if the impact on capital taxes will happen later on at the autumn statement.
From a VAT perspective, a key point of Budget 2021 is the announcement to extend the reduced rate of VAT for hospitality, holiday accommodation and attractions. In July 2020, a 5% rate of VAT was introduced on supplies of catering, hot takeaway food, hotel and holiday accommodation and entrance to attractions. The temporary period was scheduled to end 31 March 2020. This has been extended to September 2020, when it will then be replaced by a transitional rate of 12.5%. This will remain in place until March 2022, when the rate will return to the standard 20%. The extension does provide a welcome and much needed boost to the hospitality and leisure sector. The reduction is aimed at business rather than the consumer, and the increase in profits helps to mitigate the additional costs suffered by the industry as a result of the pandemic. With additional relief available to the industry through further reductions to business rates and the Business Restart Scheme grants, it is encouraging to see sector-specific support being offered. However, for an industry sector that has perhaps suffered more than most over the last 12 months, does this extension go far enough? Even after the scheduled reopening date of 17th of May, social distancing measures will remain in place, with establishments having to operate at reduced capacity. Seasonal businesses may also be affected. The current 5% rate will increase to 12.5% at the end of September, resulting in less savings for venues reliant on bookings over Christmas and New Year. In addition, businesses have already seen holidays and other events, including weddings, postponed into 2022, by which time the relief will have ended and VAT returned to the standard rate of 20%.